everyone. Welcome to the FSR press conference. On my right is far right is John Cunliffe, who's the Deputy Governor for Financial Stability. On my left, Andrew Bailey, who's here in his capacity as Deputy Governor for the PRA. And on my immediate right, the Governor of the Bank of England, Mark Carney.
Thank you very much, Jenny. Good morning, everyone. Today, what I'd like to do is outline how the Bank of England's Financial Policy Committee is ensuring that the financial system can dampen shocks and help firms and households to seize opportunities associated with the UK's new relationship with Europe and the world. The FPC's efforts are part of a four-part Bank of England plan to first identify clearly the risks to financial stability and monetary stability, and to be straight with the British people about them. Secondly, to build on a taken over recent years that have increased the resilience of the financial system. Third, to supplement this core strength with contingency measures implemented in the past few months to address immediate risks to financial stability. And fourth, to take action to support jobs and growth during a period of heightened uncertainty. So let me start with the first, clearly identifying risks to financial stability. At its meeting in March, the FPC judged that, and I quote, "The risks around the referendum were the most significant near-term domestic risks to financial stability. Some of those risks have begun to crystallize. In particular, our concerns that the historically large current account deficit could be vulnerable to sudden shifts in foreign capital and sharp adjustments in sterling appear to have been borne out. Portfolio flows into UK equities and corporate debt appear to have slowed, and sterling experienced its largest two-day fall against the dollar since floating exchange rates were reintroduced almost half a century ago. Secondly, it's now more likely that adjustments in commercial real estate could tighten credit conditions for UK businesses. Foreign flows of capital into commercial real estate fell 50% in the first quarter of 2016. Transaction volumes have fallen further during the second quarter, and share prices of property REITs dropped sharply following the referendum. In addition, the number of vulnerable households could increase due to a tougher economic outlook and a potential tightening of credit conditions. In particular, there's growing evidence that uncertainty about the referendum has delayed major economic decisions, such as business investment, construction, and housing market activity. More positively, sterling's sharp depreciation should provide support to UK exporters, and the sharp fall in gilt yields has meant that all-in corporate borrowing costs actually fell modestly over the course of the past week. In addition, financial markets have managed the volatility around the referendum well and have not added to stress. The second part of our plan relies on a series of measures taken over years to build financial resilience. The Bank of England has consistently strengthened the resilience of the UK financial system over the past 7 years. Major UK banks have raised more than £130 billion of capital since the crisis, and their aggregate Tier 1 capital now amounts to 13.5% of risk-weighted assets. In recent years, the FPC and PRA have tested bank balance sheets against scenarios far more severe than the country currently faces. For example, all our major banks and building societies passed last year's stress test, a test which included losses twice those incurred during the global financial crisis. Recent moves in financial markets have borne out this progress. Although lower bank equity prices are consistent with investor concerns over an uncertain economic outlook and lower bank profitability, overall bank funding costs have not increased. Markets are focused on returns, not concerned with resilience. The third part of our plan has been to implement a range of contingency measures to address immediate risks to financial stability. Responding to more intensive supervision by the PRA, as well as their own risk assessments, major UK banks now hold more than £600 billion of high-quality liquid assets, or around 4 times the amount before the global financial crisis. In addition, eligible counterparties have pre-positioned collateral with the Bank of England, and this creates the capacity to access more than £250 billion of funds through our normal facilities. In March, we pre-announced a series of auctions around the referendum date, and last week we announced that we will continue these weekly auctions until the end of September. The Bank of England is also able to provide substantial liquidity in foreign currency if required. We expect institutions to draw on this funding if and when appropriate, just as we expect them to draw on their own resources as needed in order to support markets and provide credit to the real economy. The fourth part of our plan is to take action to support jobs and growth during a period of heightened uncertainty. This begins with using the flexibility embedded in the UK's regulatory framework to the greatest extent possible. Our regulatory framework is explicitly designed to allow up to half of the capital and all of the liquidity buffers held by banks to be used to absorb shocks in times of stress. This ability to draw on buffers will encourage banks to continue to lend to UK households and businesses, even if times prove challenging. And to reinforce these incentives, the FPC is announcing today that it's reducing the countercyclical buffer on banks' UK exposures from 0.5% to 0% with immediate effect. This is a major change. It means that 3/4 of UK banks, accounting for 90% of the stock of UK lending, will immediately have greater flexibility to supply credit to UK households and firms. Specifically, the FPC's action immediately reduces the regulatory capital buffers by £5.7 billion and therefore raises those banks' capacity to lend to businesses and households by up to £150 billion. For comparison, last year, with a fully functioning banking system and one of the fastest growing economies in the G7, total net lending in the UK was just £60 billion. To be clear, this measure only supports domestic banking activities, and PRA supervisors will ensure that no bank increases dividends or distributions to shareholders as a result of this action. When combined with the already strong balance sheets of UK banks, today's action means that those UK households and businesses who want to seize viable opportunities in a post-referendum world can be confident that they will be supported by the financial system. Now, financial institutions, like the rest of us, desire certainty to plan for the future. And in this regard, it's important to note that the bank's liquidity framework is now well established, that the FPC finalized the overall bank capital framework last year, and that the bank will continue to steadily implement measures to develop ring-fence banks and to end the scourge of too big to fail. Moreover, nothing in financial regulation will change until the process of the UK's withdrawal from the European Union is complete and EU law ceases to have effect in the UK. The law is the law and the rules are the rules. In conclusion, the UK has entered a period of uncertainty and significant economic adjustment. The efforts of the Bank of England will not be able to fully and immediately offset the market and economic volatility that can be expected while this adjustment proceeds. More fundamentally, the future potential of this economy and its implications for jobs, real wages, and wealth are not the gifts of the Bank of England, but will be driven by major decisions made by others within the public and private sectors. However, by promoting monetary and financial stability, the bank can help facilitate these decisions, smooth the necessary economic adjustments, and help UK households and businesses seize new opportunity. We have a clear plan. We're rapidly putting its main elements in place, and it's working. The FPC's past efforts have created resilient financial institutions which can draw on their substantial capital and liquidity reserves to support the real economy even during challenging times. The contingency measures we put in place are addressing the immediate risks from the vote and ensuring that the financial system dampens shocks rather than amplifies them. And the FPC is supporting the real economy by ensuring that banks and building societies can use the substantial capital and liquidity buffers they have in place, and our actions today alone have released up to $150 billion in new lending capacity to the economy. Going forward, The bank will continue to consult and cooperate with all relevant domestic and international authorities to ensure that the UK financial system can concentrate on doing its job so that the British people can do theirs. And our various policy committees will work closely together to ensure that, during this period of heightened uncertainty, the measures we take will be as effective as possible. In this spirit, the bank can be expected to take whatever action is needed to promote monetary and financial stability, and as a consequence, support the real economy. These efforts will mean that we can all look ahead, not look over our shoulders. And with that, Andrew, John, and I will be pleased to answer your questions.
And can I ask you to say who you are, who you represent, please, and just to stick to one question for the initial go-round. Thank you. Ed, and then Kamal.
Thank you, Governor. Ed Conway from Sky News. What would you say, Governor, to those who say, well, we're a few weeks on from the referendum, the FTSE is actually higher than it was before, stock markets don't look like they're in crisis, the pound has stabilised, the government can borrow at less than 1%. It doesn't look quite as scary to a lot of people as they thought it might be.
Well, I think the first point, let's focus on the positives, which is that financial markets are doing their job. They are adjusting to this change. As I said in my opening comments, it's detailed in the report. Those markets have functioned pretty well. There's been some reduced volumes in gilt markets and some heightened volatility, but not inconsistent with the scale of the issue. The directions of movements, and I'm not commenting on levels, but the directions of movements have been broadly consistent with some of the adjustments that are necessary. In particular, the adjustment in sterling, which has been significant. It has been significant, and it was sharp in the initial period. In fact, volatility spiked to its highest level ever. But that adjustment has moved in the direction that is necessary to facilitate some of the economic adjustments that are going to be required in the economy. I think the comment I would make in terms of the equity markets is I would focus a little more on the domestically focused stocks, the FTSE 250 or the component of the FTSE 100 that is principally serving this economy. There's been a much more significant move in those equities in pound terms and in common currency terms, certainly in dollar terms, quite notable. And that gives a sense of investor expectations, which may not prove out, but investor expectations of the direction of the economy. The thing I'd end with and reinforce is that the movements in financial assets prices related to banks have been quite telling. As I said in my opening comments, again detailed in the report, the movement in equity prices consistent with concerns about the economic direction, economic uncertainty, but the all-in funding costs for banks, and whether you're measured in the cash markets or the derivative markets, haven't really budged. And that is a testament to the resilience that has been built up. So it's a concern about the economic outlook, consistent with what's happening in the equity market, as opposed to concern about resilience. And all of that comes back together to an ability for this economy to adjust, the financial system doing its job, helping this economy to adjust. And of course, that adjustment builds on the fundamental strengths in the UK, which are legion, starting with human capital, extending through rule of law, the infrastructure, and I would argue the institutions as well.
Governor Kamal Ahmed from the BBC. You said before the referendum that there was a possibility of a technical recession. Given what the Financial Stability Report has said about the resilience of the financial system, have those fears been alleviated? That in fact the dynamism of the UK economy, the falling sterling, will actually create a boost which maybe wasn't expected before the referendum? Well,
first off, the FPC doesn't make an economic forecast. It looks at the outlook for financial stability, the risks around that outlook, and then takes measures to build resilience and, where possible, alleviate specific risks. So that's the core responsibility, as you know, of the FPC. For forecasting, we rely on the MPC. The MPC's forecast is Last one was in May. The next one will be in August. So I'm going to defer the answer to that question until the MPC has opined. The MPC, though, always recognized that the movement in sterling would help with the adjustment. The question is the scale of the other effects, the impact of this change on demand, particularly, and one sees it initially in demand for large, lumpy, irreversible investments, whether somebody's buying a house, building or buying commercial real estate, making a large business decision, business investment. There was growing body of evidence across all of those before the referendum that all of those were slowing. It was an observation of the MPC in its most recent minutes, and everything we've seen since, albeit its early days and it's mainly survey-based, has suggested continuation of those trends. So that does suggest movements in the economy that are consistent, notwithstanding the move in the exchange rate, or even taking into account the movement in the exchange rate, that there is the prospect of a material slowing in the economy. To go to your question, last point on it, is the financial system doing its job? Yes, the financial system is doing its job. It's helping prices adjust. The banks and building societies are up and running. They're open. Credit is available for people who want it. We've reinforced that today, and that will help this adjustment without question. It's going to dampen, it's going to cushion, it's going to make it better than it otherwise would be, and that is, so we're in a very different world than we were in 2007-8.
Chris, and then Phil, and then Joel.
Chris Giles from the Financial Times. The FBC's taken some action today to encourage the supply of credit. Can you tell us from your discussions with people in markets and with banks whether you think there is a squeeze on credit, or whether the action is really in the demand for credit, and what you're hearing about the willingness of people to take on loans at the moment?
Yeah. I think your question's spot on, because if we do see a slowing in credit growth, it'll be demand-driven, not supply-driven. The decision of the FPC, which was very carefully considered, as you would expect, took into account, in effect, we're saying that we are seeing signs, and expect them to continue for a bit, of a change in the risk environment, be much more risk-averse environment. In that environment, and given the core resilience of the banks, it's important to ensure that there is no question about the availability of credit. That's the one thing we want to take off the table, and we're fortunately in a position, due to the hard work of people, started long before I showed up. Actually, only Andrew can take credit for this at the table. That's and many other things, I might add. But to build up this capital over time, we're in a position where we can release some of that capital, take that issue off the table. Thus far, we've also been able to reduce concerns about market functioning as well. So again, the financial system is functioning, which should help the adjustment. And the decisions about demand for credit will be more governed by the degree of uncertainty about the future relationship with Europe, future structure of this economy, how quickly that's resolved. As I tried to say last week, it'll be more governed not by the plans of the Bank of England and what we're putting in place, we do our core job to help, but by plans of others which are still being formulated.
Phil Aldrich at The Times. You talk about the buy-to-let being one of the risks. I just wondered, how severe do you fear a buy-to-let housing crash could be in the UK, a buy-to-let induced housing crash could be in the UK, especially in light of the other concern you raised, which is just generally high levels of household indebtedness?
Yeah, well, we have been concerned for some time about these issues, the interplay between high levels of household indebtedness and the housing market, and the possibility that there will be more vulnerable households because the economic environment turns, and that could weigh on the economic outlook, make the subsequent pickup shallower. that's why we put in place, and we're pleased that we put in place a few years ago, the measures to restrict high loan-to-income borrowing for owner-occupied. It's also why the PRA took action earlier this year to ensure that there was no slippage in underwriting standards in the buy-to-let market, that people were testing against income if they were using that as a backstop, that they were using reasonable stressed interest rates. And those measures help ensure that the protections in underwriting exist. They make it less likely that we will get this amplification channel if the housing market does turn for a sustained period of time. So it is something that we're watching closely. I want to stress one other thing, and I apologize if it sounds a bit like a broken record, but this is a different. It comes to the same conclusion, but from a different point, which is, you know, Phil, we conducted a very severe stress test, housing stress test, in 2014 against the major banks, building societies, with a 35% fall in house prices, 30% fall in commercial real estate, prolonged recession with unemployment and sharp increase in interest rates. So every way you could stress bank balance sheets against challenges in the housing market, we did it. And then we made sure that those institutions were well capitalized against that. In fact, not just able to withstand it, but able to lend in that environment. And what we're seeing now, and there's some detail in the report on this, even by the most pessimistic view of where bank equities have gone, is nowhere near that stress test. You know, not even half of that stress test, which gives you a sense, or should give you a sense, and really people who are watching this or who ultimately go to a bank, the confidence that the core of this system is very strong. So we may see some volatility, we may see things move around, but the system is going to be there for someone who wants to buy a house or a business person with a viable plan.
Joel.
Joel Hills, ITV News. A couple of questions, if I can. About the easing of capital requirements. Sir John Vickers will make the point you're doing that from already low levels. With hindsight, do you regret allowing banks to pay out dividends in the run-up to the vote? Would it not have been better to wait and see in terms of this issue of capacity? And my second question, if I could, about you've told us a lot about the robustness of banks. What about the robustness of British households? You note here that the FPC's policies have restrained growth in the number of vulnerable households. How many households are vulnerable to an economic slowdown?
Okay. Well, I think the FPC's actions today speak for themselves in terms of whether we have no regrets about the dividend policies of the banks. The fact is, our view is that the banks are in a position where they have more capital than they need for the economic environment that they're in and that they will be in over the course of the next few years. And in fact, they can be part of the solution, not part of the problem. And that's why we can release, first point. Second point, the market agrees with us. If you look all in, you know, we've had this big shock, which has resulted in a quite notable fall in equity prices, not just of banks, but of domestically focused British companies. We have movements in the gilt curve, which, to put it mildly, are not consistent with an acceleration in the pace of growth in this economy. I'll put in the negative, right? And yet, all-in funding costs for banks have not moved. So they have a tough environment, but the judgment around their fundamental creditworthiness has not changed. And why is that? Well, it's because they've got a lot of capital, a lot of liquidity. They've got more focused business plans. It can always, you know, there's always things they can do better, and the market is focused on them ultimately getting their returns up, which partly explains the equity performance. But in terms of doing their core job, they're well capitalized, and because they're well capitalized, because they built that 130 billion of capital, we're able to, for them to release now this additional amount of capital, which we had carved out for the countercyclical buffer. So this is the system working as it should. But John, actually, I'm going to ask you had a second question on households, and I'll ask John Cunliffe to answer that, please.
But the ratio of household debt to household income is something we've been watching very closely for a number of years. It was high before the crisis. It came down after the financial crisis, and stayed relatively quiet. But in recent years, it's been starting to move up a little bit as the economy started to grow. It's around 134% at the moment, I think. And we monitor that closely for precisely that reason, because households that are highly indebted, those cohorts of households that are highly indebted, tend to cut back their consumption very strongly when they're faced with interest rate shocks or income shocks, and there's a vulnerability there. That's precisely, as the Governor said, the reason we took the action we took a couple of years ago to restrict the flow of high loan-to-income mortgages and to ensure households were tested when they took out new mortgages against increases in interest rates. And that action has had a result. It's slowed down the growth of high loan-to-income mortgages, and more importantly, it's reduced the numbers of households that would be vulnerable, extremely vulnerable to income shocks or interest rate shocks. But clearly it's something we need to watch closely for the future for precisely that reason.
Helia and then Jill.
Helia Ebrahimi, Channel 4 News. Governor, can I just get your feeling for how fragile you think UK households are in the aftermath of the Brexit vote? As John was saying, you've got debt to income at 132%, historically high level. Back in 2014, the FPC judged that household indebtedness didn't pose a risk. How do you feel about that now?
Well, in 2014 is when we took the measures that John was just describing, I alluded to earlier, around high loan-to-income mortgages. So we were worried about the distribution of high indebtedness, and we took action. We took quite notable action. There has been some progress since then. The number of highly vulnerable households, so households with debt service ratios above 35%, has come down. Overall debt service ratios have come down as well. So there has been sort of steady improvement in the distribution of debt and the proportion of households that are highly vulnerable, shall we say. Obviously, though, the economic environment matters tremendously. If it's a difficult economic environment for a long period of time, those distributions shift, and it becomes more of a concern. One of the ways to avoid that situation, or to minimize that situation, or to cushion against that tendency if a shock is bringing us in that direction, is to make sure that the financial system is functioning and is there, and to the maximum extent possible, to ensure that people know that it's there. Because what we don't want to have happen is that there's a judgment that people lived through 2007, 8, 9, 10, 11, 12. It wasn't a lot of fun, 13 even, and there's traces of it even today. But certainly in the darkest period of the crisis and the recession, it was out of the question to go for credit. So opportunities fell by the wayside. We don't want that to happen now. We have a system that should ensure that that doesn't happen, and we're sending a not just a signal with today's action, but really creating room on the balance sheets of these institutions. And I'd underscore that in our discussions with them and our supervision of them, that we're confident that they have the capacity and the orientation to meet their responsibilities. That will help with the situation with households, to go back to your point. Jill.
Jill Treenall, The Guardian. Again on this issue about households and their level of indebtedness, what is your clear message to people who are thinking about taking out a loan or moving house at a time when you're also warning that we could indeed be entering very difficult economic times? What should people be doing?
Well, here's deep insight from a central banker. We're advising people to be prudent. We always advise people to be prudent, whether times are good or times are difficult. Certainly if you're taking out a mortgage, you at some point over the life of that mortgage, times will be difficult. It might be at the start, it might be 5 years in, it might be 10, 15, whatever. So you want to make sure as a family, as an individual, that you'll be able to service that mortgage if times are tough. You don't want to lose your flat, your home. And so thinking through where interest rates could go, where your earnings could go as appropriate. That's the first thing, but we would tell you that if we were in the 10th year of a boom, the same, be the same message. I guess we're in the 10th year of a boom. It'll be my successor's successor. But the second thing, though, is this point which I just made to Helia, which is that the system will be there. If you do want to take out a mortgage, it should be there. If it's a viable business opportunity, viable for the economic climate, the system should be there. Because of the hard work over the course of the last 7-8 years, and because we're able, as a consequence of that, to ensure that capital can be deployed to lend to businesses and households as they need it.
Paul Davies from the Wall Street Journal. So just on the current account deficits, I mean, you draw out in the report the importance of investment income and so on, and declining profits in mining companies and things like this, which will benefit from a falling pound. Trade will have, a different effect. Do you have any sense of how these things will balance out, and whether overall a falling pound is going to be beneficial for the capital account, for the current account, or worsen it, or what the sensitivities?
Well, in and of itself, the movements in sterling should be beneficial for the account, for the current account. There are some issues in terms of the composition of the move, given where some of the major investments of UK institutions, UK individuals are. They tend to be more resident in Europe than they are, for example, in the US. But overall, the adjustment, as you point out, helps on the trade balance side, will help on the capital account side, helps on the liability side, because most liabilities in the UK are denominated in sterling, so we have right-way risk, if you will, in that regard. So it helps with the current account. But of course, the current account is a product of a variety of factors, including the balance of savings and investment decisions, and that will, the pace of investment will also be quite important in terms of where the balances go over time.
Scott Hamilton, Bloomberg News. On Thursday, you indicated that further monetary policy easing may be in the offing over the next few months, over the summer. Could you give us an update about, in terms of the financial stability implications of any cut in interest rates? You said that interest rates can go lower than 0.5. What is the new floor? And might the FPC prefer the MPC to do quantitative easing instead?
Well, I'll try to answer this carefully in a way that doesn't mislead, because I don't want to mislead about any decision that the MPC, has. The MPC has yet to meet since the referendum. We're about to start the process for the July meeting, so we haven't had formal deliberations about these issues. But the basic point I want to make, and I referred to it on Thursday, referred obliquely maybe to it here, but I'll spell it out, which is that in this environment of heightened uncertainty, an environment where bank rate is already quite low, and it's extremely important that any monetary action, whatever it would be, is well aimed, that it focuses on the domestic economy, that it takes into account potentially unintended or counterproductive, if you will, offsetting consequences in the financial sector. I think pretty clear, you probably know my views on the more extremes of negative interest rates, and giving back with the other hand, or taking back with the other hand what you're trying to give with one. Certainly the case in the United Kingdom, given the importance of building societies here and the structure of both mortgage and deposit markets. So the general point I want to make and really stress is that during this period, the banks committees, the PRA, the MPC, and the FPC are working very closely together, and we're really thinking through the potential consequences, intended and unintended, and net consequences of any actions that any of the committees might take. and that very much holds for monetary policy.
Tim?
Tim Wallace at The Telegraph. Governor, yesterday Standard Life closed the doors on one of its commercial property funds because of high outflows. Do you think the sector can cope with this level of people leaving the commercial property market? And are you looking at ways to stop a rush for the door and stop any commercial property fire sales and so on that might follow, impacting the wider market?
Yeah, well, let me just say 2 words at the start, and I'm going to ask Andrew Bailey to speak to this. We have the FPC has highlighted issues broadly around commercial property for some time. We've also been highlighting issues around liquidity mismatches in UCITS or REITs or mutual funds, depending on how they're structured, and the importance of having mechanisms to manage outflows consistent with the underlying assets that are held. So these issues we have been flagging. But I may ask Andrew to expand a bit because he's straddling between his 2 roles.
Yes, so I'm here as the retiring PRA, but I'll just put my FCA hat on for a moment, if you don't mind, to answer that question. So I think that, just to start with the sort of underlying structure of what we've got here, we've got open-ended funds which hold illiquid assets, and I mean that in the sense that they don't, of course, revalue naturally. There isn't a market that revalues them naturally, and there needs to be a valuation process. So the fact of suspension is designed into these structures. It's not a panic measure. It's designed into these structures to deal precisely with that situation where there's been some shock to the market, if you like. There's a presumption of a valuation adjustment, which is quite hard to capture in illiquid assets on high frequency. And the purpose of the suspension is to create a pause, if you like, to allow that process then to happen. And that's sensible. It's absolutely sensible. And it's sensible because in the structure of these assets, I'll come back to that in a moment, and it's sensible because, of course, what from a conduct point of view we do not want is differential treatment of investors. So we do not want those who get to the door quickly to get a better deal than those who don't, or those who either don't or choose not to. So the suspension is designed into the structure. Now, we are, I should say, and I speak as the FCA here, as I said, we are in very close touch with the firms. Let me be clear on that. The last point I'd make is just to stand back from that, and it really comes back to the point the Governor made at the outset. I think it does, and I think it does point to issues that we will need to look at in the design of these things, because it comes back to my fundamental point about holding illiquid assets in open-end funds that revalue or are required to be revalued at high frequency. So there's a mechanism for putting the sort of the orderly pause in. But my own feeling, and this is, as you can understand, having been there for 2 and a bit days, this is a preliminary feeling, is that we will need to come back and look at that issue, both from a point of view of conduct and from a point of view of systemic stability.
Harry and then Caroline.
Harry Daniels from LiveScore News. Governor, and just the FPC and maybe the wider context of the bank, do you have the capacity to handle Article 50 when it's actually triggered in terms of the operations and making sure the bank can do its job efficiently during the talks, the 2 years, and then thereafter? Do you need more staff? Do we need more guidance? How does it work?
The short answer is yes. We do have the capacity. I mean, obviously, it's a major event, and we will have to reprioritize what we work on, but we will do that. In the hierarchy of things, is really be hard pressed, aside from the day-to-day responsibilities of our committees. I'm hard-pressed to think of, in fact, I'm not going to try to think of something that's going to be more important than this process once this process begins. But of course, our contribution would be technocratic, it'll be analytic, it'll focus into to the efforts of the government, and we'll be guided by them. Let me stress, though, that what I said at the outset, which is that until that process is finished, and actually beyond that, potentially, depending on how that process is structured and what the conclusions the country comes to and the agreement, until EU law ceases to take effect, the system remains the system. It's in place, and we will We will abide by it, we will enforce it, we will act consistent with the laws and rules that currently are in force. So there is that certainty for institutions and the protection for deposit holders and others that come with it.
Caroline?
Caroline Binham from the Financial Times. Governor, 6 or 7 months ago when we were here talking about the counter-cyclical buffer, you stressed that it was a reallocation of capital from the Pillar 2 bucket to the counter-cyclical one, that there was no great raising of capital for banks. Today we're told that the release is going to help with the provision of credit. I'm just wondering, which is it? Is it significant? Is it not significant?
Sorry, I'll let you finish.
And just there was a clarification on one of your comments in your opening remarks. I just wanted to check. You said that it would be fine for banks to run down their buffers there to about half with the capital and all of liquidity.
Yeah. Okay. So on the first point, the two are consistent. I'm glad you asked the question because it's important to be absolutely clear about this. What happened over time, and quite rightly, before we had the countercyclical buffer system in place, is that over a series of years, the PRA would conduct stress tests either on an individual bank basis or initially across the banks. And they would ascribe some of the judgment from that stress test would put in place a sort of macroeconomic element to what's called the PRA buffer. So it's real capital that had to be raised by institutions or held by institutions for cycle risk. I'll call it cycle risk, right? Once the countercyclical buffer framework came into being, it made sense. PRA board agreed, the FPC agreed to take that capital and reclassify it as as part of the countercyclical buffer, and that was equal to about 0.5% of risk-weighted assets. So that was actual capital, 5.7 billion, as it turns out, that was reclassified. And because of the nature of the PRA process, they had done this for about 3/4 of the banks, but those banks accounted for 90% of the lending. So as of 6 months ago, we had a situation where those banks had an explicit and transparent now 0.5% buffer for the countercyclical. There were the other 1/4 of banks, mainly challenger banks, that were going to have to raise capital to get up to that 0.5% because they hadn't allocated it yet. So they had to actually raise capital. What we've announced today is we've taken that amount, that 5.7, said, you don't need it because the risk environment has changed. And that releases it. So it's actual capital that was released. We couldn't have done that 6 months ago, 12 months ago, before we had actually moved it there because it hadn't been identified. It didn't have that purpose. And there wasn't a way to be consistent across the institutions. And so it's a very clean, so it's real capital that's there that now the banks don't need to have. Now, if I can move to your second question, because it goes directly into that, which is how do these buffers work? When you have a counter-cyclical buffer, it sits on top of the other buffers, whether they're systemic buffers or the so-called capital conservation buffer, right? They all sit in a stack. If the bank's capital goes down, is reduced because they make losses or they expand their balance sheet too fast into those buffers, then they start to have restrictions on dividends and potentially compensation, or both. And it could be, if it goes well into it, elimination of dividends, supervisory judgment there. But the system is designed that if there's a major shock, major persistent shock, the institution can dip into the buffer. It has consequences. The consequences of fewer dividend payments, potentially over time no dividend payments in order to rebuild. But it hasn't breached its regulatory requirements, and that's the big thing. So it's not a hard minimum level. You can understand why management would like to avoid it, but they don't have to avoid it. And if there's a big unexpected shock, they may not be able to avoid it, and it may be better for the system that they dip down into it. Now, our institutions are well north of these buffers. We've made it the distance between the buffers and where they are today higher by 0.5%, larger by 0.5% by the action we've taken. But we have explicitly designed the system so that we have more buffers, a substantial proportion of buffers relative to the minimum, so we don't get, so that the system has some flexibility in it if there is a very large shock.
Sue Chan, Telegraph. Just to follow up on commercial property risks and potential spillovers into the real economy, given, as you highlight in the report, that a substantial proportion of small and medium-sized enterprises use commercial real estate as collateral when unlocking access to finance, the fact that a 10% fall in real estate prices leads to a 1% fall in investment, and the fact that the MPC has suggested that delays to economic decisions tend to raise unemployment. What are the potential ramifications of a commercial property crash on joblessness?
Yeah, well, it's, I think your question did a very good job of summarizing the channels, and I think what's important for that we as the FPC don't just identify a sector that, you know, something bad could happen to it, and it's not necessarily an issue for the economy in and of itself. It has to amplify through other channels. You know, certainly one of the most important is the first one you raised, which is that, you know, 75% of small, medium-sized enterprises, of lending to small, medium-sized enterprises, is secured against commercial property. And so a generalized shift in the commercial property outlook or a generalized deterioration in the commercial property outlook can affect, certainly on the margin and maybe more severely, the ability of those enterprises to have access to credit because they don't have the underlying collateral, or it's not worth as much. Obviously, the commercial property sector, the construction sector, is an important part of the economy, has been an important part of the economy. We're seeing indicators not just in terms of volume of transactions in commercial property, but leading indicators around construction that in the run-up to the referendum, you know, was slowing, to put it mildly, in construction, and possibility that that is going to continue. That has knock-on effects, direct knock-on effects on jobs. We're not going to put a precise, again, as the FPC, we're not going to put a precise number on it, but it is an amplification channel, but which, you know, we worry. Now, what can we do about it? Well, one of the things that Andrew Bailey and his team have done, and maybe Andrew, you can expand if you wish, have done over the years is to ensure that kind of the exposure of UK banks to commercial property has been kept quite manageable. This has not been driven by UK bank lending, these shifts in commercial property. And so the consequence of that is that we've cut off, if you will, or greatly reduced one of the amplification channels. This is not a big issue for UK banks. And that means to go back to businesses and households with other activities, that it doesn't have a knock-on effect there and just reinforces the bigger message we're trying to get across, which is about, you know, the one thing to take off the table here is availability of credit. But Andrew, I don't know if you want to.
Well, I think you know, that's right. So I think there's two things I would just underline that point. I mean, there has been quite a big shift in the composition, as the Governor said, of commercial property financing. So if you go back to the period before the financial crisis, it was heavily bank financed. Now, because of the volatility of commercial property prices in this country, I would characterise it as what appeared to be debt financing on the balance sheet of banks, actually providing what was economically equity financing. And that was part of the problem of the financial crisis. What we've seen since the financial crisis with the in recent years, upturn in commercial property prices is far more equity financing coming in. Now that seems to me sensible because it's equity financing what is an equity, you know, something that has the economic characteristics of equity. Of course, that means, you know, it will absorb losses when they happen, and as it should do. The second thing, I don't think it's in this the latest FSR, but I would point you to a chart we've used quite a few times in the past, which distinguishes those. It's exactly to your question about small firms. Actually, those companies that are heavy users, as you said, of commercial property as a source of security and borrowing, and those that aren't. And what you see from that chart, as I remember it, is that the latter group that don't rely have a very different economic property in terms of how they adjust to changes in economic cycles. They can adjust more rapidly. So understanding that part of the system is important from the point of view of the overall macro context.
James Burton from the Governor, your report talks about how the fall in bank equity prices has been consistent with roughly half the fall in your stress tests, and it talks about that being consistent with a rise in unemployment to 7.5%, falls in residential and commercial real estate prices of 15 to 20%, and a GDP growth reduction in 3 years of 4 percentage points. So is that now the worst case scenario that the bank is planning for?
No, that's a very clever question. That's a arithmetic calculation. It illustrates if you took the entire adjustment in bank equity, the falls in UK-focused banks' equity, and ascribed it to a worse economic environment, and used the stress test, using both 2014, 2015 stress tests, it's equivalent to roughly half, and arithmetically roughly half is exactly consistent with the numbers you just quoted. Okay. We have to factor in a couple of things. First, that's an equity market view that's then blended with a bank stress test. Secondly, that equity markets sometimes under or overshoot, so it's not precise. Thirdly, there is an element of banks' share price movements that have been focused on returns, and not just returns because the economic environment could get worse, but returns because do they have the right business model? And that has affected certain institutions more than others. There's also a question, to go back to, I think, Scott Hamilton's question about the path of monetary policy and the potential feedback to bank returns there as well, which arguably also, for some investors at least, and some institutions would have affected their equity price. So all of that is to caution, taking that as a forecast. What that analysis says to us, though, is that you have this big potential shock priced in to the equity market, and look what happens to the judgments of the funding markets to the bank's creditworthiness. All-in funding costs basically haven't moved. They've actually gone down a bit, but if you factor in a higher cost of equity, they more or less haven't moved. And they'll bounce up and down as time goes on. But there's nothing like what happened during the Euro crisis or during the global financial crisis to UK banks, which reinforces that even if there were this big economic shock, and I'm not saying there will be, but even if there were, there's the confidence of capital market investors in the underlying resilience of these institutions. Maybe just less enthusiasm about their prospective returns. Right.
Jason.
Hi, Jason Douglas from the Wall Street Journal. Could I ask you just to say a little bit more, please, on the international picture? Have you detected any spillovers to financial stability globally from the Brexit vote? Are things well contained? And I suppose what kind of things are you discussing with other central banks in order to mitigate any problems that might arise?
Well, the first thing I'd say is vis-a-vis the major central banks, as you'd expect, we've been in close contact with them, even more intensive contact in the run-up to the referendum and in the immediate aftermath. I would say that that coordination, cooperation was effective in building mutual understanding of the risks and the potential channels, helping to prepare private financial institutions, but also making sure that the networks that we've built, whether they're through swap lines or other mechanisms, were in place, could be used if they needed to be used, and it's very welcome. I mean, that was the system working well, and it helps ensure that if much more extreme scenarios had transpired, that the system could have addressed them. So that's the first thing. In terms of spillovers of the actual vote, as markets settle down a bit, look, it has heightened focus on these issues of bank profitability, bank balance sheets in some jurisdictions. There is a sense of that there could be a heightened degree of risk aversion for a period of time. That oscillates a bit in markets day to day, but general sense that there's a spillover there. Certainly we've seen quite, I think, remarkable, in the true sense of the word, movements in global government yields, which suggest a certain path for the economy and as a consequence for policy. So the spillovers are notable. But the system globally has worked well. And I have every confidence it will continue to do so. And then the last comment I'll make is that, and again, it's ultimately a judgment of the MPC, but in the run-up to the vote, the global economy, most indicators, in aggregate indicators, the global economy was that the pace of growth had firmed. And so the environment was a more constructive environment than it would have been certainly earlier this year if the vote had gone the way it did earlier this year. And I say gone the way it did in terms of the expectations relative to the outcome.
George Hay from Reuters Breaking Views. Governor, if Scotland eventually does vote to leave the UK, how would that affect your regulation of the banks that are domiciled there? I mean, would you be asking RBS to re-domicile down here, like happened a couple of years ago?
Well, it's a hypothetical on a hypothetical because we don't know. There is no referendum, as you know, planned in Scotland, and we don't know the regulatory environment that would be in place if indeed that were to happen. So we have a double contingency. In general, you do want mind and management of an institution situated where the bulk of activity is taking place within the same regulatory jurisdiction in general. But that's as far as I'll go on that.
Sam Nussey from Nikkei. So we've seen the capital buffer reduced to 0% when there was previously the suggestion that it might come up towards 1%.
Yes.
You've mentioned the possibility of further easing over the summer, be that rate cuts. Many thought that 0.5%, we're already at the lower bound, was many would have said, or perhaps further quantitative easing. Some people would say that would question whether the bank has further scope for easing given the level we're already at now. What would you say to those criticisms, and is there the scope for perhaps further unconventional measures of the type we haven't seen before?
Yeah, well, Sam, given it's an FPC press conference, I don't want to go into a bunch of detail on monetary policy, and also given that the MPC is just starting its process later this week. What we have said as an MPC is that and this is in our letters to the Chancellor and our minutes, that we do have a wide range of tools available if further easing were merited. And it would be prudent if the judgment of the MPC is that further easing is merited. It'd be prudent to look at that full range of tools to decide what would be most effective at this time in this environment. And just to repeat what I said to an earlier question, in order to help make that decision, it requires close cooperation, discussion. And more detailed analysis, cooperation, discussion with the other committees. It's a decision of the MPC, but it helps it be better informed. And we have a structure that allows us to do that, and we will do it.
Would you have time just for one more, if there's anyone who hasn't had a... Yeah.
Hi, Nils Pratley, The Guardian. Some politicians in the pre-referendum period accused you and the bank of creating financial instability with your comments on the risk of Brexit. Andrew Leadsom, for example. Is there anything those politicians could say or do to make your life or your job easier now?
Wow. That's no. It's we're not asking people to make our lives easier on that front. I mean, it's a technocratic institution. We work with whoever's in government, and this committee has a statutory responsibility to assess the risks. I mean, You'll note that on the front page of it, this report is submitted to Parliament pursuant to our statutory obligations. And if it's a financial stability report, whose first job is to identify the risks to financial stability, we have to call them as we see them, based on analysis and an objective assessment. And that is what we have done. And as a consequence of doing that, we're able to take some measures to mitigate those risks if they start to crystallize. A number of things that we've been talking about this morning have been examples of measures that the FPC and the Bank of England more broadly have taken to address risks that some of which are crystallizing in and around the referendum. And all of that means that this economy will be able to rely on its financial system, adjust more smoothly, and move forward, which is what I think everyone wants. Thanks very much.
Okay, thanks very much, everyone.